Hey everyone, welcome back to our channel. If you're new here, don't forget to hit that subscribe button and the notification bell so you never miss an update. Today, we're diving into the world of equity and shares, two crucial concepts in business and investing that can shape your financial future. Whether you're an investor, entrepreneur, or just curious about how companies are structured, this video is for you. Let's start with the basics. What exactly is equity? In simple terms, equity represents ownership in a company. It's the value that would be returned to a company's shareholders if all the assets were liquidated and all the company's debts were paid off. Think of it this way, equity is what you actually own after all obligations are met. It's the foundation of wealth in business and investing. Now, let's talk about the different types of equity. There are mainly three categories you should know about. Shareholder equity. This is the equity that shareholders have in a publicly traded company. It's calculated by subtracting total liabilities from total assets. It's often used as a measure of a company's financial health. Owner's equity. For smaller businesses, especially sole proprietorships, this is the owner's stake in the company. It's similar to shareholder equity but on a smaller scale. Private equity. This refers to investments in private companies. Private equity firms usually invest in or buy out companies, aiming to improve them and later sell them for a profit. Each type of equity plays a unique role in the financial ecosystem, whether it's building wealth or funding growth. Now, let's move on to shares. Shares represent units of ownership in a company. There are two primary types of shares, equity shares and preference shares. Equity shares. These are the most common type of shares. They come with voting rights, which means shareholders have a say in major company decisions. Equity shares also have the potential for higher returns through dividends and capital appreciation, but they're riskier since they get paid last if the company goes bankrupt. Preference shares. On the other hand, preference shares offer a fixed dividend, making them less risky. However, preference shareholders usually don't have voting rights. They're prioritized over equity shareholders when it comes to dividend payments and in the event of liquidation. Choosing between equity and preference shares depends on your risk appetite and investment goals. Let's look at a real-life example. Imagine Company A and Company B. Company A is a tech startup with high growth potential, offering equity shares to attract investors willing to take on more risk for higher returns. Company B is a stable utility company offering preference shares to those who prefer steady, predictable income. As you can see, equity shares might offer explosive growth, but they come with volatility. Preference shares, meanwhile, provide a steady income stream with less risk. So, there you have it, a comprehensive look at equity and the different types of shares. Whether you're investing in the stock market or considering equity for your business, understanding these concepts is crucial. If you found this video helpful, give it a thumbs up and let us know in the comments which topics you'd like us to cover next. Don't forget to share this video with anyone who could benefit from it. Thanks for watching, and see you in the next video.